With FICO stock down 40% year to date, is it worth a deeper dive? Well, let's put it through the Pulse framework and find out. Let's switch to the Excel view and load up the template and put in the ticker FICO, and let's look at it together. All right, well, starting with the P, the economic profits. I mean, this is one of the best charts I've ever seen. Economic profits are positive, they're rising, amazing, not much else to say. Underlying free cash flow, the U, also amazing. You have positive and rising free cash flows, and you have the net income to free cash flow to net income ratio at almost 100%. Perfect. We can move on. Leverage, the L, net debt to EBITDA 3 times. That's fine. It's okay. Nothing to worry about, but nothing amazing either. That gets us to valuation factors, the S and the E. And the S, the smooth free cash flow yield. That's, despite the 40% decline, I was hoping for a little bit better, but basically this is a stock trading at 50 times free cash flow, which is pretty darn pricey, right? And then switching to the E, the EV cap rate, almost 3%. That's not a good number either. EV cap rate has the advantage of looking at the whole enterprise value. It also looks at the trailing 12-month data. And here, 3%, that's, still pretty pricey. So if I were putting it all together, pretty amazing fundamentals, and unfortunately very, very expensive valuations still, despite the 40% decline in the stock. So for me, this is one of those situations where it's interesting, but later, not today. It wouldn't be a priority in my pipeline. If you want to do this for your own stocks, you can take a look at the link in the description to the template, and I'll see you in the next video.